The third is, of course, my own capital at work. As I said, if I lose it, where am I? As a first generation entrepreneur, either it's make all or lose all. So that fear factor will always be there, which is important as well, I think. And lastly, we are built around a singular idea of investments into a certain asset class. And that's what we do. So we have no other diversification. It's not like we're running a mutual fund and we are running, by the way, another PMS vehicle, and we're also running insurance, and we're also doing banking. So one doesn't work, it's fine. So all our exits are in this one basket, and therefore you have to protect it with all your might. For that, the ability to actually engage with all that matters, from a regulator to bankers to developers to marketers to influencers to economists to industry bodies, becomes very important. So we've created a very cohesive ecosystem around us that keeps us sharp, that keeps a very strong alignment of interest along with us, so that if we succeed, they succeed, and vice versa.
So you learned from your transaction advisory, applied it to fund management, and clearly you're learning from your fund management and now the acquisition of NCCL. Sure. So I'd like to hear a little bit about that. What was the rationale behind that acquisition, and how do you see that business grow?
Again, something we didn't sort of think about even not less than 2 years ago. And which is why it's not part of our IPO objects, because we didn't know we were going to do this as late as December 24 when we went public. It happened, but it ended up happening in August of 25. Yeah. But it was very clear to me that what are we? We're solvers of problems. That is what we are at the core, and we're great solvers of constraints. So whether it's our advisory, whether it's our capital is not standard capital. You can't say, oh, I want a home loan and let's go to Nisus Finance and give me the largest amount of loan at the cheapest price. We're not that. Or we're going to give you the best LRD. Or we're going to give you the maximum amount of construction finance for the next 10 years at 8% or 10%. No, we're not that. That's banking. We're solution capital. We'll try and solve for a certain set of problems, a certain set of opportunities. So that's exactly where I saw the biggest constraint today was actually delivery. When you are moving, and if you see the balance sheets of largest of the developers in the country, everybody has gone from selling 7,000-8,000 crores of inventory to 20,000-25,000 crores of inventory in less than 2.5-3 years. How do you do that? You need to deliver. You cannot have a spate of uncompleted projects. And for that, you need capacity. And we don't have the capacity. So therefore, if you can own capacity, then you're going to rule the roost. So I saw now that there is today the availability of capital. It's come in reasonable quantities. Credit funds have been raised, private equity has come back, but in a bigger way, fewer players. We've increased our book size. So capital is available for the worthy. And capital markets have been very vibrant. Number of developers have gone public. Their cap table has become far stronger. Their ability to raise capital has become much better. So capital is not a constraint. Demand is again not a constraint because you don't have inventory overhang. I remember way back in 2010, we used to say, oh, Mumbai's 7-year inventory overhang. We made stock for the next 7 years. Today we don't have even 17 months. So demand is not a constraint. Even though prices have gone up, it's become so expensive. I don't know who's buying it, but it's getting sold nonetheless, right? Offices are getting consumed nonetheless. Warehousing is full nonetheless. So demand is not a constraint. Capital is not a constraint. So the biggest constraint is delivery. So if you can own that piece, so you own the capital, you own the ecosystem, but the constraint of delivery is very important. And we saw that first hand during COVID. We were stressed about ensuring the projects complete. The money was sitting in the escrow. Customers were waiting for delivery, and unless the delivery happens, we will not get paid back.
The money,
And the contractor would not show up, and he would not pick up our calls. And I said, this is not happening. We need to be able to control outcomes, because that is the risk factor we never thought will happen. We never thought that if you're paying contractors, they will not come to the site, they will not deliver, we will have a problem or constraint of supply. So that's really when I realized that if you can control that, we can obviously scale up. The second thing is also creating an ecosystem. We believe in creating something which is far more enabling. Now we have common clients, right? We have the same counterparty, we have the same developers, we have the same people and then we have our own order book. So when I'm lending 2,000 crores in private credit, I'm effectively delivering 4,000-5,000 crores of effectively GDV on the ground. When I'm doing that, they also need a contracting companies. Again, they're all stuck. So I said, what if I can own one, provide it to my own investee book, accelerate this, and therefore unlock value for one of the oldest construction company in India, an 80-year-old company with a strong legacy. So then it became a very strong win-win where you can cross-pollinate clients, you can cross-pollinate order books, you can cross-pollinate the new things that are getting built on the ground, which we are seeing, we are witnessing, we are investing into, and bringing the same solution for this company to construct, build, and deliver. So therefore, there was a very large synergy between our companies, which I saw. And of course, the good part was that I've known them for 15 years. So there's a lot of familiarity about this company, what it did, how it performed, what were its strengths, etc. And therefore, there was a unique God-given opportunity when the promoter said, you know what, I'm willing to exit. I'm 92. And I said, well, then this is a God-given signal. Let's not let it go away. And so we put in a lot of effort to work this, come up to a price that made sense, be a part of the entire structure, and get the buy-in of the management, because they were the ones who've been running this company for the last 35, 40 years. And get their buy-in, have a management-led buyout, enable them, give them the opportunity to now scale to what is the potential of this company is again very, very exciting. So we're builders by definition. And if our capital and our intelligence can actually work in a favor to unlock value and solve one of the biggest constraints. And by the way, we're really surprised that constraint is even bigger in the UAE. At least in India, people tender. When a Lodha went for a development, they tendered and our company won the bid. But in the UAE, there's no tender. The contractor decides which project they want to build. And that is the opportunity there. I said, I'm already there. I already have my friends who are doing large development. And they're not asking me for money. They're saying, Amit, can you bring your contracting company? So I'm like, wow, this is amazing. You're now addressing a $2 trillion market which has zero contractors. The 3 companies from China are exhausted. The 2-3 companies from Saudi are exhausted. Arab Tech and some of the old players are gone. Where will they complete that volume of work?
What do you think is the reason for that? It's clearly a great opportunity. You mentioned $2 trillion, $3 trillion of infrastructure coming up in Dubai. So why is it that no contractors willing to...
See, the scale at which things have accelerated are unprecedented in history. We've never had this scale up in urbanization. Today, UAE was all about Dubai. Today, UAE is about Abu Dhabi. It's about Ras Al Khaimah. It's about Al Quwain. It's about Sharjah also. So when you have 5 Emirates accelerating 24/7, how do you get this capacity overnight? It took this company 80 years to build itself. It's taken L&T 76 years to build itself. It's taken Shapurji an equal amount of time to build itself. These companies take a very long time to build the capability, bring people, processes, systems, vendor management, technology, deliver it in a certain framework with the risk, safety, getting bank credit lines, very hard. So it is very difficult. It's very easy to buy land and sell. But the hardest is to find the entire organization which can actually complete it.
Execute.
And that is very hard, which is why somebody has to then say, oh, let me get some labor, let me get some material, let me get something else and try and aggregate it and somehow get the project done. Because that's the only other plan B. So because scale has happened so fast, it has been very difficult for people to actually get that capacity built overnight. And of course, you want to trust a person with the necessary background, with the necessary track record. Now, you can't build track record overnight. Those who have track record have already filled up their books. They don't have any more capacity. So then how are you going to build more over time? So then fortunately, we have a company which has capacity.
I want to know how you look at debt, because NCCL does have debt on the books. And I know you trimmed a little bit of a stake to pay off that debt. But in a way, debt is going to be a part of, I guess, the construction business too. So I just want to understand, how are you looking at leveraging and debt?
Sure. It's a very important question, Mubina. And it is where the value driver can be or it cannot be. So debt is a good accelerator for returns to equity. But too much debt can obviously kill it. And we've seen enough organizations who effectively are sitting in insolvency because of debt, because of bank NPAs. So when it comes to us, while we're lenders by choice, and we put out a very large sum of money in loans and we understand credit really well, but we're not natural borrowers ourselves because we understand that we're not a full-scale NBFC where we need to borrow 6 or 7 times of our tier 1 capital. We need to manage credit on the asset side as well as on the liability side, work on NIMs, work on NPAs, work on prudential norms. So we don't really have to do all of that. Largely all our capital, when it went to credit, is all equity linked. And because it is equity linked and sitting in a fund, we're deriving fees from putting this, sort of sums of money to work in the marketplace. But debt is good because it helps you sort of preserve equity to some extent without diluting it, which is how venture debt also came into being, so that you don't keep on diluting to raise more and more growth capital. But of course, it has to be serviceable, which means unless there are strong cash flows to back your debt, which is very predictable, very, very solvent, has enough and more cover to how much debt you're taking, it becomes destructive. So when we borrowed, of course, for the first time to actually buy NCCL, we were very clear that we'll pare it down in actually no time, because we have very strong cash flows. We have the ability to raise equity because I've only diluted 25%. So if need be, I could further pay down my equity if needed, which is I don't think is a necessity.